Have an investment property and wondering how it affects your age pension? In this video, I'll break down exactly how Centrelink assesses an investment property under the assets test and the income test, and what it means for your age pension. Let's get into it. After meeting the age and residency requirements, how much age pension you can get comes down to means testing, specifically the assets test and the income test. Centrelink looks at both tests independently and applies the one that gives you the lower payment. Here's the assets and income test thresholds from 20th of September 2025 to 19th of March 2026 for your reference. If you're new to the age pension system and want to understand how these thresholds work, check out my other videos where I explain the basics in more detail. These thresholds apply to your total assessable assets and income. An investment property is often a large part of that, so understanding how it affects both the assets test and the income test is absolutely critical. But first, what is considered an investment property for age pension purposes? You probably already know that generally your principal residence is an exempt asset, not included in the assets and income tests. An investment property is any real estate you and or your partner own or have an interest in that is not your principal residence, regardless of whether it earns income. So basically, any real estate assets you rent out, leave vacant for any amount of time, such as a holiday home, let someone else live in for free, living when you are not at your principal home. Importantly, this applies to properties in both Australia and overseas. It's not just houses or apartments, it can also include vacant land, bush blocks, commercial property, hobby farm, and more. Here's a fairly comprehensive list from the real estate details form, which you'll need to complete for each property you own when applying for the age pension. Now let's talk about how an investment property is assessed under the assets test. What's included is the property's current market value minus any relevant debts. For example, if you own a rental property worth $500,000 with a $200,000 mortgage secured against it, the amount counted under the assets test for your age pension is $300,000. In other words, only your equity in the property is assessed. It sounds simple enough, but many people get caught up in the details. So let's take a closer look at these two concepts. Current market value is what the property would likely sell for today. It's not what you originally paid or what you hope it's worth, and it's different from the property value shown on council rates and valuation notices. When you apply for the age pension, you don't need to have the property professionally valued. You can give your own estimate of the property's current market value, and Centrelink will take it into account, but they don't just accept it at face value. Instead, they compare your estimate to their own data. If there is a significant difference, they may adjust the value or even arrange a professional on-site valuation at no cost to you. In that case, a valuer may contact you and visit the property to complete their assessment. Their valuation might be higher or lower than your estimate. If the new valuation changes your payment, Centrelink will let you know. After that initial current market value is established, Centrelink checks and adjusts it over time based on the property's local market conditions. They use a professional third-party valuation service that provides indexed real estate market data by postcode. And if you disagree with Centrelink's assessed value of your property, you can request a review. This is especially important if your property has been affected by something that isn't reflected in the general market data for your area, such as fire damage or the discovery of a termite infection that uniquely impacts your property. Now let's look at the other part of the equation, relevant debts. The key word here is relevant because not all loans are treated the same way. If the loan is secured against your investment property, it's considered a relevant debt and can be deducted from the property's current market value, reducing its assessable value under the assets test. Similarly, if you have an unsecured loan and can provide evidence that it was specifically obtained to purchase an investment property, it can also be treated as a relevant debt and deducted in the same way. However, here is a common trap. If you take out a loan secured against your principal residence to buy an investment property, Centrelink won't count that loan as a relevant debt That means it won't reduce the market value of the investment property in your age pension assessment. For example, if you took out a $200,000 loan secured against the equity in your home to purchase an investment property with a current market value of $500,000, Centrelink will still count the full $500,000 for your investment property in the assets test. The loan is ignored because it's secured against your home, which is an exempt asset. This situation isn't unusual. Many people use their home equity to invest. While it makes sense from a tax point of view, under Centrelink rules, it can inflate your assessable assets and potentially reduce your pension entitlements. If this applies to you, it may be worth exploring refinancing options to have the loan secured directly against your investment property instead. Now let's look at how an investment property is treated under the income test. What's included is the net rental income, which is gross rent minus allowable expenses. You can find the gross rent figure on your annual rental statement from your property manager or by checking the lease agreement. Allowable expenses typically include things like council rates, water rates, property management fees, insurance, repairs and maintenance, loan interest. Notably, even if the mortgage is secured against another property, such as your principal residence, the loan interest can still be an allowable expense as long as the loan was used to purchase an investment property. This is different from how Centrelink treats loans under the assets test, where the security matters. If the loan is secured against your home, it won't reduce the assessable value of the investment property. Another point worth noting is that not all deductions allowed for tax purposes are accepted by Centrelink. The following expenses are not considered allowable under Centrelink's income test: capital depreciation, special building write-off, cost to build, cost of borrowing money such as loan establishment fees. If the net income is a negative amount, your assessable rental income is simply zero. Losses from one property cannot offset against income from another property or any other source of income. When you apply for the age pension, Centrelink will ask for a copy of your tax return or a rental profit and loss statement to verify your rental income. If these documents aren't available, such as when the property is newly purchased, Centrelink allows you to deduct 1/3 of the rental income to account for expenses. In addition, it will also deduct the interest on the loan used to purchase the investment property. Once the next tax return becomes available, the estimate should be discontinued in favor of the actual figures from the tax return. Now you understand how your investment property is assessed for the age pension. You might be wondering, if I have available cash, should I be using it to pay off the investment loan? Watch this video before you make that decision. Thanks for watching. I'll see you over there.